start recording so that we can share this after the meeting. So first of all, thank you everybody for joining the call. I know it's tough to give up an hour of your time, especially in the evening, but we're super excited about this offering and really excited to talk to you guys about it and explain why we're excited and talk through our business plan and all of those kind of great things. I know several of you are probably new to the mobile home space, so we do have some slides to kind of talk about the advantages of mobile homes as well. So just a second, I'm realizing got people in the waiting room and it's hard for me to admit them while I'm sharing. So, okay. So quick disclaimer, this is just kind of the legalese. We are going to share this deck so you can read the whole thing, but I don't think it's worth going through. Essentially what this is saying is that there's some confidentiality in here. You're welcome to share it with others, but please let us know ahead of time that you're sharing it so we can keep track, because we're theoretically supposed to be aware of anybody that has access to this. So please let us know ahead of time. The other thing on here is that while the numbers in here are to the best of our ability, obviously we can't predict the future. So that's essentially what this is saying. So we're going to go through the highlights as well as the team that's going to be operating the mobile home parks. And then we'll talk about why we like mobile home parks, mobile home communities. We'll talk about the markets that these are in, and then we'll drill into the individual communities. And then we'll talk about our business plan and how we're going to really add value to these communities. So first, Ryan, do you want to go ahead and introduce yourself?
Yeah, thanks for being here, everybody. It's great to have you on board. My name is Ryan Hill. I was a residential real estate agent for 13 years, had some single family rentals. About 2 years ago, when we moved from Washington State to Idaho, jumped into the mobile home park space and now the retail space as well. So really my job is to maximize operational efficiencies and occupancy as we continue to scale. I work directly with our mobile home park managers, provide support and guidance, and then also work with municipalities. So just developing those positive relationships to increase our capacity to infill our parks.
Awesome. Thanks, Ryan. My name is Dan Reese, and I am a former financial advisor. I actually spent a decade. That's where most of my formal training is with the national firm, but I got burnout selling managed portfolios. So I actually had the opportunity to be able to switch careers and pursue my passion, coaching high school football. It was great. Along the same lines, I was able to, my wife and I have a couple businesses, able to work alongside her and manage our real estate investments as well. And so at HBR, I focus on finding used manufactured homes, sourcing brand new homes, and working on the capital expenditure budget. I'm super excited for this portfolio. I'm excited to share some of the things that we've uncovered along this due diligence journey as well.
Great, thanks guys. So apologies for me getting in and out of the deck. I am not quite figuring out how to do admit people into the room without having to escape. So quick background on me. I think I know most of the folks on this call already, which is great. So I'm over the finance side of things. So I have a background in finance, MBA from Duke, and so I kind of am that geek that does things. I did a lot of work in corporate finance, specifically in the high tech sector, as well as large scale program management. In this case, I particularly have done all of the underwriting, and will also be managing all of the bookkeeping, watching the optimization along with Ryan, working with park managers on any kind of delinquencies. All those kind of things are going to be rolling up to me. So two other team members that aren't on the call that we wanted to introduce. So we've got Pete Stojic. What's really cool about Pete's story is not only does he have decades of experience with manufactured communities, but the other cool thing is he's actually one of the sellers of this portfolio. So quick background on that, there are 3 general partners that are selling this portfolio to us, and 2 of them are staying with the deal, which is pretty great. And I just want to point out that between the 2 of them, they're not only reinvesting personally, but I think many of the folks on this call are actually friends with at least one of them, which is just says a ton about this deal, that we have so much faith in the portfolio and the upside here, that we have great people sticking around. So thank you in advance for that. Our final general partner that we wanted to introduce is Ben Anderson. So Ben, we've been working with for a long time now, and he's going to be partnering closely with Dan, specifically on infill. So what you'll learn if you're new to the mobile home space is infill is huge. It's a busy job. takes a lot of work. We're going to explain a little bit of it and how we have some strategic advantages in the space to make it easier for us. But we got a lot of work. So we've got 2 general partners focusing on that. And then just a second as I admit another person. I also wanted to introduce our regional team. So these folks are actually going to be employees of the portfolio working with us. So they're already working for us in Kansas City. They manage a couple of our parks there already. One of the main reasons we wanted to expand to Des Moines is we love the Midwest. We love Kansas City. We love Des Moines. We love some of those other cities that we're kind of looking at as well. But it's just a strategic play for us to be able to scale up there because we already have a really strong team. So in addition to Kristen, who's our regional property manager, she'll be managing each of the park managers in Iowa directly. And we've got Doug coming on, who's going to be responsible for the actual on-site infill. So we'll be doing the strategic sourcing, placement, determining what quality of homes goes where, and then Doug will actually oversee the actual on-site inspections and installations and things like that. We also have a rehab crew from Kansas City that will be helping us out in the Iowa portfolio as well. So what's pretty fantastic about that is that we have several homes, and again, we're going to get into this in a moment, but we have several homes that are already there that are just waiting to be rehabbed and sold. And so we're able to leverage our existing team to make that happen very quickly. So now we'll transition a little bit more into the actual portfolio. So the quick highlights, I think everybody probably already knows some of this information anyway. So we've got 4 communities. There's 273 sites across all 4 of them. And we're actually about 4 weeks out from closing at this point. So getting into a little bit more on the return. So the way the returns work is, first of all, we have an 8% preferred return to investors. What this means is that investors will be getting 8% monthly before any other cash is distributed. So that's the preferred return. It's as guaranteed as it gets. And then the one caveat that I want to call out on that is, and I'll explain this a little bit more. We're planning to make our first payment November 2021. So we're holding back for 6 months on that first distribution. And I'll show you some numbers on why, but it's a very strategic decision. So that 8% will be paid out monthly beginning November 2021. And then above that, you will also get additional cash flow that exceeds that 8,000. It'll be shared with investors as well as the sponsor team. And we're averaging about 12% overall cash on cash. So what that means is there's lots of returns on here, lots of numbers and metrics. The cash on cash is the actual cash flow you receive divided by what you've invested. So if you look, for example, at the table at the bottom, if you look at year 2, there's $10,763 is expected to be paid out in year 2 for someone that invests $100,000. So you can interpolate that to be less if you're going to invest less, or extrapolate if you're going to go higher than that to kind of get an idea. But we baseline it at 100K to make it easy. So what you would do to figure out your cash on cash is you'd take 10,763 divided by 100,000. So you're about 10.8 in year 2, and you can see it just goes up from there. And then in year 5, we actually do a cash out refinance. So with the cash out refinance, we're projecting that we will pay back the entire investment and a little more. So if you've invested 100,000 in year 5, we expect all 100,000 and an additional $10,000 to come back to you. And then after that, you'll continue receiving cash flow. So because your entire investment's been returned at this point, there's no preferred return anymore, but at that point, we have all upside cash flow we're getting. And if you took that same 8,459 that's coming in year 6, and you would be dividing it by 0, because at that point you have 0 in the deal, which is fantastic because you're getting infinite returns and you've got all of your principal back. So we love this strategy. The other thing I want to point out on this refinance, that second bullet at the bottom, is this is after we've held back $1 million. What I mean by that is we're actually refinancing at such a higher rate than the current value that we'll be able to take $1 million and hold it back for more development, which we'll get into that in our business plan in a few slides here on why we want to do that. And then the rest of it will be distributed, and we're still able to pay back 110,000. So pretty exciting there, lots of great upside. So moving back up to the upper tables here. So average annual return. This is essentially taking all of this money you're getting divided by what you've invested and then divided by the holding period. When I look at deals personally, this is one of my favorite numbers to look at because it's one of the easiest to understand on how am I doing, and it's a really good one to just compare how would I do if I was doing the stock market compared to this deal. So if you consider your cash on cash a dividend like you would get in the stock market, average annual return is the dividend and the appreciation all combined. So really good metric to just kind of see how we're doing. And then the equity multiple is just another quick way of seeing how good this deal is. And essentially what this does is you're saying over 4 years or over the whole period of 10 years, you will quadruple your investment based on our assumptions and based on our business plan. We're projecting a 4x return. Dan, are there any questions in the chat so far that you've noticed that I should answer?
Nothing yet, Brett.
Nothing.
Okay, cool.
Nothing.
Thanks, Ryan. Okay, so I will transition over to Ryan, who's going to talk to us about why we like mobile home communities.
All right. So, aside from the fact that billionaires Warren Buffett and Sam Zell, so Buffett, he owns Clayton Homes, which is the biggest mobile home manufacturer in the US, and also operates two of the biggest mobile home lenders, 21st Mortgage and Vanderbilt Mortgage. And Sam Zell, he's the largest owner of mobile home lots in the US. They're heavily invested in this space, which says a lot. So supply and demand is, even with COVID, affordable housing is even at a higher need than it was before. So roughly 65 million are in poverty, and demand for safe, affordable housing is never been higher. So there's roughly 45,000 mobile home parks in the country, and about 100 a year are torn down or shut down for usually other commercial purposes, so apartments or retail, with only about 10 mobile homes being built in the country. So just the actual amount of mobile homes and parks in the country decreases every year. So that supply demand piece. And most cities won't allow new mobile home parks to be built. There are some cases where that happens, but recession resistant. So mobile home parks are essentially the bottom housing rung. So that means that compression of everyone moving down. So especially when times get tough, there's even an increased demand for mobile homes, mobile home parks, and couple that with the dwindling supply. So during COVID, actually, mobile home parks were one of the strongest performing assets. Most operators were getting about 95% of tenants paying rent. Compare that to 50 to 70% for retail, kind of during the height of COVID of people actually paying their rent. The tax benefits are pretty awesome with mobile home parks. So we'll be doing cost segregation, and we can explain that a little bit later. But depreciation for mobile home parks, especially the infrastructure, it's a 15-year schedule versus apartments, which is 27 and a half year. And commercial properties are 39 years. So that depreciation piece can really help your investment dollars and save on taxes in the end. So that's a pretty cool piece about mobile home parks. And then the forced appreciation. So filling, and we'll talk about this a little bit more, but filling vacant lots. So if you fill one vacant lot in our portfolio here, it increases the value of that portfolio by, it could be $35,000 to $45,000+ just on one mobile home being placed in the park where there's a vacant space. And Brett will get into that a little bit more later. And then mobile homes actually aren't so mobile. Once they're placed, 80% of them, they don't move again. So for our tenants and our clientele, and it's 3,000 to 6,000 usually to move a mobile home, and they typically don't have that type of cash laying around. So once they're there, they're usually there for good. And then just lower tenant turnover compared to apartments, with about 47% turnover year over year. For mobile home parks, it's about 10 to 15%. So a lot of real positives for why mobile homes versus other asset classes for sure.
Thanks, Ryan. So just drilling in this a little bit more, I realize some of these terms are probably new for a lot of people, but on the left side, this is how traditional real estate works. And this is a very simplified profit and loss statement. Since you have income minus expenses, and that gives you net operating income. And then you'll have your debt service below that, and then that's your cash flow. What's cool about mobile home communities is it calculates the same, but we have bonus income afterwards. So you have income minus expenses, you still have your net operating income, and then you still have your debt service. But after that, you have your home income. So just to clarify what I mean by that is Ryan was talking about mobile home parks being not so mobile. A huge reason for that is that generally the people living in mobile home parks own their home. And so
Right. You go to the next slide. Sorry, bud.
Yeah, sorry, I was going back and forth. You own your home, and so as the owner of the park, we're just collecting the rent from the lot itself. And so that's when you look at the income and expenses and then operating income, it's actually just valued only on the lot itself. You don't count any of the rent from the home, which is great because then you have very little expenses. You have less turnover, as Ryan explained before. But then you still get some home income for anybody that still is in the park. And specifically in our case, where we're selling homes over time, we're getting what's called lease to own income. So for example, the way that works is if we buy a home for $15,000 or $20,000 and sell it, the tenant can pay it off over time. And so you're gaining that cash flow month over month, which is just, again, bonus cash flow. So the other thing that's kind of cool, and Ryan touched on this again a second ago, but if you look at, again, on the right here with mobile home income, we have net operating income, and in all real estate, the valuation comes from net operating income divided by what's referred to as a capitalization rate. A capitalization rate, unlike single family residential, a capitalization rate is relatively objective in the sense that you're looking at market comps and kind of seeing what's the standard capitalization. So for example, if you had $1 million net operating income and you had a 10% capitalization rate, then you would take $1 million divided by a 10 million or 10% capitalization rate, and that would be worth $10 million. So that's essentially how you get your value. What's great about that in a mobile home park is that if you add one mobile home to the portfolio and you're getting $300 in rent each month from that home, then you would capitalize that over 12 months and then divide it by the capitalization rate, and that one home can add to your portfolio or to the value of the park another $40,000 to $60,000. So even if it only costs you $20,000 to place a home, your value can go up $60,000. And that I can't think of any other asset class that you can do that. So pretty phenomenal option here that just really makes it another reason why we love mobile home parks. So drilling into the markets now, I'll let Ryan touch base on why we like these markets.
All right, we have two really solid metro areas, and what we look for when we're looking at a metro is 100,000 people plus. It's a great indicator for a very strong market, and then $40,000 median income and above, along with a diverse job market. So just kind of keep that in mind as we're going through these slides. Do you have the first one up there? Okay. So Des Moines, if you're familiar with Iowa, it's the largest city in Iowa. Headquarters to 60 companies, most notably a center for the insurance industry, as well as many agriculture-related businesses. It's the cultural and economic heart of Iowa. And a lot of people, they would probably characterize it as a big, gentle city. It still retains that small town feel with large city amenities. You can see the population very strong, and we're especially excited about Prairie Village, which is it's really West Des Moines. It's just to the west, and that's where major development is happening in the Des Moines area. So we're in the path of growth that direction, and then median income is well above what we're looking for, which is great. And then Cedar Rapids, it's the second largest city in Iowa and also has a strong economy. It's a rich culture and a lot of artistic pieces to heritage in that community. They're in the third or fourth phase of a 5-phase airport development, which is increasing international trade to the Cedar Rapids area, which is exciting just for the business and growth opportunities. Strong education system as well there, and just a lot of diverse job opportunities makes both of these one of the best places to live. So very strong MSAs, which we're excited about on those. And as far as employment, so Hy-Vee, if you're not familiar with that, so think Albertsons, Safeway, I'm trying to think of another major
Kroger.
Supermarket chain, Kroger. Yeah. So especially Des Moines, their headquarter, that's a major employer. So, we're looking for jobs, job types that, more working class. And you can see that there's a good amount of that here. In fact, one of our parks is next to a major distribution plant for Hy-Vee, and we'll talk about that a little bit more. So we have some exciting possibilities with that. Brett, did you want to talk about any of these others?
Oh, sorry, I'm on mute. No, the main takeaway, as you mentioned before, we got some really strong employers here, but also lots of diversity. So definitely some depth on the employment. And then Dan will touch on the community specifically.
Yeah, so there's a map of the portfolio right there. You see most of them are right around the Des Moines area, with Tipton on the east side of the state. Brett, if you can go into the next one, we're talking about testing demand, which is super exciting. This was several months ago when we started looking at this portfolio. What we did is, this is our proprietary model of how we test the market. So on the left is a Facebook ad. We funnel traffic to a messenger, Facebook Messenger message, or we have a text service that we use as well. And we get them to fill out a Google form. And then from there, we'll go over the results that we got. So right here, this shows the high demand. And so we gauge solid demand is about 10 interactions across 7 days. So that's typically the industry standard. When we look at this, across the top is you got the different communities across the top. And then going down, we only did a 48-hour testing period because it proved exactly what we were hoping. So you see on the first row, is that the row? Yeah, we got columns and then rows. Okay. So the first row, we have the text messaging tags, where that showed a good amount of engagement across all the portfolio. So if we average that out across 7 days, we're going to need about 1.5 interactions per day to show kind of solid, strong demand. So when it shows across this on just the text messaging, we had the Prairie Village had 24, average about 12 text message tags per day, which showed about 10 times what the actual average would need to be for a solid market. So that's why we're super excited about that. All of this, the Google form completion, as well as the Facebook Messenger messages, showed very, very good demand across the portfolio, which has got us to the next point of actually pursuing this portfolio. So that proving that demand was the first hurdle that we overcame. And
it's a really important step. We've walked away from many parks because they failed that. So.
Exactly, and a lot of the rural parks that are out there on the market, they don't see this type of demand. So if we overview the portfolio right here, this is a good summary, and I'm going to go through this relatively quickly, but all of these numbers are actually going to be on the individual slides for the parks. So this data, looking at the overview, we see we have the 273 pads, which is zone 4, and across that we have 180 homes on those pads, and that includes the lease to own contracts as well. The homes are included in there. So I'm going to, Brett already took a minute to define what the lease to own are. I'm going to take a little bit of a dive on there as well, because there's those two components, the lot rent component, as well as the lease to own contract component as well. So the total payment for somebody on a lease to own contract, say in Boonville, would be $355 for the lot payment, but then there could also be another $400 for the lease to own contract. And so the way that this works is, over the course of the contract, that $400 will go away when they complete their contract. We will hand them over the title of the home. These homes are actually they have VIN numbers just like cars, and they actually are held via the DMV. So it's basically they're living in a, we're not going to say they're living in a car, but or a van down by the river, but they're basically living in a vehicle down by the river. Because Boonville, there's a couple of these places that are actually really nice locations that actually are by rivers. So with that, going with the lot rent always being a constant, the lease to own is one of those payments that will eventually drop off. And why we like this affordable housing space is when somebody owns their own home, they're paying about a quarter of what they would normally pay at your traditional multifamily affordable housing residence. So that's really nice because it's a win-win, because our resident-owned homes are the ones that are typically our nicest homes, because there's a lot more pride of ownership there. And so our goal is to be able to get our residents, we want all of our residents to own their own homes as we start to infill. And that's why we're on these lease to own programs versus versus trying to just own these ourselves. Sorry for that tangent, but so if we continue back on the slide, the third one down, sorry, Brett, you could stay on that one. I just want to go through the lot rent and the market lot rent. So across the board, you see the lot rents from $355 all the way down to about $300 average there across the portfolio, which shows that when you look at the market lot rent just below it, you see that there's significant amount of upside here by getting to the market lot rent. And so these communities, as we take over, and we're going to see as we go through the communities, there's some that have deferred maintenance, so we can't move the lot rent right away. We're going to have to make significant improvements as part of our business plan to show the community that we're going in that direction to meet the market demand. Another element of that's unique to manufactured homes is just below the market lot rent, you'll see the utility bill back upside. And so manufactured home space, a lot of these communities actually are master metered. And what that means is there's the master meter where the community is actually paying for the water and sewer usage. And so three of our four communities are actually doing that. So we're going to hold off on probably raising the rent for those during the first year, because we're going to implement what's called a utility reimbursement program that we're calling RUBS. And this is going to allow us to be able to recapture those costs in those communities. And so it's basically, as you see across the board, we got $48 in Boonville and $62 in each of the friendly acres. That will allow us to be able to recapture some of those hard costs to us, which is almost like a lot rent raise, which is a great opportunity for us. Plus, there's going to be more accountability for the residents if they're getting billed for something that is going to be used that they're using where right now they're not. It's a cost that they don't really care about. And then the last two rows, as Ryan talked about from the market, the median home price and median income price just shows that how significant these markets are. So, Brent, we can move on to Prairie Village now.
Yeah, I just wanted to clarify real quick on the median home price. That's the median single family home price in the area. I confused somebody before that's what we were selling the mobile homes for, but we look for that number to be high. We want it close to 100,000 or higher, so that it tells us we can bring in mobile homes and sell them easily in the area.
Yeah, that's perfect. Okay, on to Prairie Village. So this village, just like Ryan and Brett said, is one that has one of the most potentials in a booming metro area. So the biggest asset that we have at Prairie Village is location, location, location. It's just, it's in a thriving area in the West Des Moines area. But it's also the park that has the most deferred maintenance issues, from overgrown trees. There's road repairs that need to happen. And then prepping, we got to prep some of the home sites as well. So in the West Des Moines area, it's just a short drive from amazing shopping centers. Basically right across the street is a brand new subdivision that's got homes from the $500,000 to $600,000 range. So it shows that it's in an amazing location with amazing schools as well. So, but there's significant vacant homes. And if you go back to kind of when we tested the demand, this is the park that actually had the highest demand and highest need for affordable housing when we posted those ads. So with this huge demand, this should be a really easy our priority for the infill strategy as we source used homes and bring new homes in. This will be a very easy park for us to fill, which is exciting. And so we would classify this as kind of a Class C community in a Class A location, which this CapEx that we're going to be able to throw into it from our business plan is going to help us make significant improvements and be able to get to the market rent within the next several years. If we want to move on to Friendly Acres Osceola. And so this is, these are actual real pictures of the communities as well. They look kind of like stock photos, but this is Osceola right here. It's about 40 miles to the south of Prairie Village. And I would consider this one as kind of a well-oiled machine. I spent a week in touring all of these parks, going through all the vacant lots. And this one was one of my favorites because it has very few lots to infill. And the managers take just a business-like approach. There's very little deferred maintenance, and the roads are amazing. It's got a cleanliness and a safety feel. They make it feel like a neighborhood. The nice thing about Osceola is Hormel meat packing plant is about 2 miles away from it. And this right here, we know that there's going to be more upside here too, because this is a high Hispanic population. And our Facebook Marketplace ad was only in English. And by simply changing a few things, we know we can get some boost right there on the interest level as well. So this one comes with the upside from the utility reimbursement program, as well as infilling a few homes. I would consider this community right here as kind of the tortoise. When you think about the tortoise and the hare story, this is the one that is slow, may not have that upside, but is just has great cash flow. Okay, Brett, we can move on to.
Yeah, Dan, you actually have a question on Osceola. So there's 65 pads total and 55 are tenant owned. What's your plan for those 10?
So what's the plan for the 10 pads that we're going to infill? So right here, this market is probably not going to be strong enough for brand new homes. We're going to look to source used homes within the range of about between 20 to 30,000. We can easily sell those either on lease to own contracts, or we could probably get them qualified for one of the lenders, either 21st or Performance Equity Partners. So that's where we're going to look to bring in good quality used homes there. I don't think we're going to be able to bring in the brand new homes there yet.
Hey, Dan, one thing to point out, when I did my first trip to all of these parks back in December, and there were 2 homes that were being installed during that time. And since then, there was another one that was put in, and those are residents bringing in their own homes.
Correct. This right here is 100% resident-owned community. So there's no lease-to-own contracts in here. And that's, I think, part of the reason why we like Osceola so much is we got residents that want to be here, and they are telling their friends and family members to bring their homes into the park as well. So it's going to be bringing new homes in ourselves rather than waiting on residents to do it is going to be a win-win, because as soon as we get them in there, we'll be able to get them in good residents' hands. And we can move on to Friendly Acres Sheridan. Okay, and this is one of the parks that I was talking about. It's gorgeous. You see at some of the pictures there, you'll see some bodies of water around it. You drive in this park, and it's very nice. One of the nicest parks I've ever been in. Sheridan is about 30 minutes to the east of Osceola. To the south, there's that serene pond, but to the north is the big Hy-Vee distribution center. And we're told by the regional manager that they are currently busing in employees because of the affordable housing shortage to this distribution center. And so they haven't been able to capitalize on that relationship with Hy-Vee because there's 2 homes in there that are currently in the process of being rehabbed. And as soon as we get those rehabbed, we're going to be able to sell those right away. So all the homes that are habitable in there are 100% occupied. There are about 10 spots I'm sorry, 12 spots that are available to bring in used homes. Again, this is probably not a brand new home market. We'll be able to bring in and source used homes to bring in here. There's very little deferred maintenance on here. It's got a nice storm shelter and managers who are very engaged. Both, I forgot to mention on Osceola, but both the Friendly Acres, they both have about 10 acres each park to expand, which Brett talked about previously about holding back some money at year 5 from the refinance for expansion opportunity. So both of these Friendly Acre parks, once we prove that that the demand is there, which we've done via the tests, now if we can infill and prove that demand, we'll be able to look forward to expanding. All right, we can move on to Country Estates Tipton. So this one, as we round out the portfolio, Country Estates is 30 minutes east of the Iowa City and Cedar Rapids market. Very solid market. This community is really just primed and ready to go. Of the community, there is it's got the most amount of low-hanging fruit for us. There is about I believe it's about 8 homes right now that are really good quality homes, but there's been a little bit of an issue with a health issue with one of the managers who's been doing the rehabs, and he fell a little bit behind due to some family health issues. And so this is where we're going to bring in a crew from Kansas City to be able to help us get these homes rehabbed within the first 6 months. And with that, a lot of the other upside is infilling the used homes as well. The nice thing about this park is it's already, you see from the pictures, there's already cement runners for a lot of the homes. A lot of the pads are just prepped and ready to go in this community. And I think, Brett, we can go ahead and move on.
Yeah, thanks, Dan. Just one other thing I wanted to add on Country Estates. So we bought this particular park. We're buying it for about 1.2 million or so, and we've already received offers for over 1.5 on people that want to just buy it. So essentially, we could make a $300,000 profit without even buying it. And we believe in this one so much based on some of what Dan was saying that we think it's worth well over 2 million once we fix it up. So this is just another one that we're excited about.
So one thing that's not on the picture there, this is right across the street from a big, beautiful new school as well. So it's in a great location.
I'm watching questions, not seeing anything new come in. There is a question on financing for homeschool. We'll address that in just a couple slides, but please feel free to throw questions in there if you have any. We're watching them. We're into our last section, which is the business plan. So just a fair warning, some of these slides get a little detailed. Don't feel like you need to understand all of them. If you have questions afterward, please reach out to me. I'm happy to do one-on-one and explain any of this or answer emails, any of that. We're more than happy to do. But we wanted to be detailed up front just so that you could see kind of what our thoughts are and answer any questions up front. So first of all, this is our high level plan, and you can see it's especially detailed in the first couple of years. So the first thing is we have several vacant lots across the portfolio. Frankly, our preference is to buy parks that have vacancies because we like infilling them. As I mentioned before, it's pretty easy once you get the home in there to increase the value of the portfolio. So I think there's a relative stigma in the investment industry that mobile homes are one of the easiest assets to manage. And that's true if they're stabilized and occupied. So if you see a park that has 99% of the lots are filled and it's all tenant owned, then yes, that's going to be a very easy asset to manage. In this case, there's some great benefits to the existing residents, but there's tons of upside because we have lots of homes we can bring in and infill. So as you can see there, we have 12 homes averaging per year. The reality is we're pushing for closer to 20. However, during COVID, there's been some delays, so we padded it down to 12. So in the underwriting, I've only forecasted 12. If we can get closer to 20, all of our returns become much better. So just to be conservative, we kept it on the 12 side. The next item down there, again, happening in year 1, is rehab and sell 12 vacant homes in the portfolio. So Dan kind of talked about which parks have homes that are vacant. We actually already have 3 of these that are expected to be ready by the time we close. So we'll have 3 ready to sell right away. And then the remaining 9, as I mentioned before, we already have a crew in Tipton that's doing rehabs. And that's the one that Dan mentioned. They've been a little slow due to health issues. And we're going to have our Kansas City crew live on site for several weeks. They're going to be there 24/7 for several weeks fixing up rehabs because we want these ready to go as soon as possible. So that's a huge priority for us to get that done. Another thing, and we're kind of cheating here, there was a 5% rent increase that went into place already that was just 2 months ago. What's cool about this is, again, we went under contract based on 2020 actuals. So we're purchasing this based on numbers that happened last year, but we're already getting the benefit of new numbers. So there's already value add here before we even step foot in the park, which is pretty fantastic on that 5% increase. Down at the bottom, all of these are kind of bigger plays. So the first one there on that bullet is we want to convert Prairie Village from a Class C park to a Class A park. This is so Class A, B, C, D is sort of something that's used in investment industry as well. And in this case, Class C is referring to primarily infrastructure changes. So we've got some road changes, road upgrades we need to do. We have some sewage and utility upgrades we need to do. We've got tree trimming, and then also a strategy on what kind of homes we're bringing in. And that'll really upgrade it to a Class A park. As Dan was talking about before, Prairie Village has just tons of really great opportunity. It's about $100 per month undervalued on rent. So lots of upside there. That's going to be a key focus for us as well. And then the next bullet there is add financing program while maintaining a blend of lease to own options. So we've talked a bit about lease to owns and how cool they are. Essentially, just reiterating on what a lease to own is essentially we would buy the home, and in a general scenario, if we buy it for $15,000 and it costs us another $6,000 to install it, maybe there's some other expenses, our all-in could be around $21,000. The value would be about $25,000 most likely, because that's generally the math we're doing ahead of time. So we want to make sure there's a profit. So at that $25,000, we would then amortize that for 5 to 6 years, so that the tenant is paying that off over 5 to 6 years. And so not only are you making that $5,000 or $6,000 profit on the back end, but you're actually making some monthly margin on it as well. And then the other thing that's really cool about this is, although even though you're making the income on the home as if you have that home rent, they're treated as tenant owned. So they own the home. They are responsible for all the expenses. They care about it more, all of those great benefits. So it's like you're getting the best of both worlds. That said, we want to do a blend of financing, and Dan sort of alluded to this, but there's essentially three or four players in the mobile home space that will finance homes. So it's essentially like going and getting a mortgage. So 21st Mortgage, again, that's Warren Buffett's company. They're the largest, and essentially the resident would go and qualify. And what's great about that is we never have to spend a dollar on that home. So the resident buys it, it goes from them. It doesn't take anything out of our cash flow. So what we've done on our CapEx budget, and you'll see this in a moment, I'm going to show you our CapEx budget, is we've budgeted to bring in some homes, which we'll then sell, and then we can recycle that capital. But when we do financing options like this, it doesn't even hit our capital. So it just is a win-win for everybody. Finally, Ryan touched on the Hy-Vee partnership that we're going to be doing. So Hy-Vee, as he mentioned, they're currently busting in a lot of their workers to their plant, and they've already approached us about doing a home sale program where we have incentives to sell to their employees so that they can have more people on site, which they're excited about. Year 2, we're going to be implementing bill backs for utilities. So this, if you remember back to Dan's slide that he showed kind of that table, across the portfolio, there are 3 parks that are not charging for utilities yet at an average of $57 per lot. So if you were to take the $57 and multiply it by the 180 or so lots that we can add this to, and then multiply that by 12 months, your net operating income would go up so much that that alone would increase the value of this portfolio by about 1.2 million, just from that one measure. So just giving you another idea, there's a lot of low-hanging fruit here that we can implement, and a ton of other work we can do that can just really increase the value of this portfolio. So again, on my underwriting, to be conservative, I have us doing this in year 2 since they just did a rent increase. But the reality is our plan is to implement that much faster. We expect to implement it in before winter this year. And the plan for that is really tenants are using the water, they're using the gas, they're using the electric. We found from our experience in other parks that actually the overall usage comes down when they feel like they're responsible for it. So it's good for the environment, it's good for the residents, and obviously it helps us out on our net operating income. Finally, in year 5, we have an option to potentially develop an additional 20 acres. So at this point, we're planning on adding about 160 or so additional mobile homes across the portfolio, which could skyrocket the value of this portfolio if we do that. But we're also looking at options for self-storage and other things that we could use with that land. One thing I want to say here is earlier when I showed you the cash flow slide, I was explaining that we're holding back $1 million in year 5 from the cash out refi to do this. However, on exit in year 10, I have not built in any increase in number of homes. So what I'm saying there is I'm actually essentially removing $1 million as buffer and still showing you all of those great returns we had a few slides ago, and assuming we still don't do this development. So there's just a ton of upside here, and we're super excited about it, and just really hope you'll join us on the journey. We do have a couple more slides, but I'm going to hand it over to Dan for a second while he's going to talk about our infill strategy, which again is one of the most important aspects of this portfolio.
Yes, thanks, Brett. So you saw our goal is about 12 homes per year. And so the thing about our infill strategy is we're going to be blending that. So year 1, I've actually just be able to make contact with a manufacturer around the Iowa area, the Des Moines area, and we're going to be able to put an order in this next week for 6 brand new homes, which we're excited about. Right now, the average kind of lead time, if you put an order in now, there's a manufacturer here in the Boise area that's about 1.5 years out. So we found a manufacturer in the Des Moines area that is only about 6 months out. So we're excited to be able to get that order in and be able to get homes in our lots by October and November of this year. So we're also in the process of getting our Iowa retailer's license, which gives us the wholesale pricing for those brand new homes. So our infill strategy for year 1 is going to be 6 brand new homes, as well as sourcing 6 used homes via different channels. And so right here on this screen, you're going to see, Facebook Marketplace is basically the new Craigslist. It's right now, those 4 homes that you see right there are what was current as of 3 days ago, but they go really, really quick. And Facebook Marketplace, if you're not pursuing them right away, you're going to lose out on those opportunities. So right now we've strategically worked with and trained several virtual assistants to be able to scour the Facebook Marketplace area, the area that we can target, looking for these opportunities. So we think that 6 used homes, good quality used homes, is going to be very easy to find. And like Brett said, our goal is 20, but with the moratoriums and with used homes being a little bit harder to find in certain areas, we're targeting that at least the 12 homes total. And so with that, we're not going to follow just on one channel and just rely on used homes. We are going to blend that strategy and bring in some brand new homes in the markets that we think brand new homes will be able to be sold in. So over the last 5 years, after walking the parks with the regional managers, the current management team had only actually brought in about 4 homes over the last 5 years. And that's outside of what Ryan was talking about, of some of the parks actually having residents bring their own homes in. So this is 12 homes per year is going to be a nice change for the parks and the managers that are actually on site to be able to have a surplus of homes to be able to get new residents in.
Great. I'm going to go back real quick a slide, just because we have a couple questions, and I think it'll make it easier to answer if I can show that timeline slide again real quick. So looking at the timeline slide, one question was, how much will it cost to develop? So we've been doing a couple of bids across, and this is actually really interesting, by the way. As Ryan talked earlier about why we like mobile home parks, supply and demand, right? There's not a whole lot of development going on right now. And so it's hard to really tell how much people are paying for this because it's just not out there. But from what we've talked to colleagues that are able to do a little bit of development, we are anticipating about $15,000 to $20,000 per pad. So when we're holding back $1 million and we want to be able to develop 160 or so pads, that's, if you're doing the math, that's not enough. But what we'll be able to do in this scenario is get a construction loan to be able to cover the difference. So we wouldn't have to do a capital call. We wouldn't have to, and we could still do some distribution in that 5th year. And again, this is that gravy scenario I was talking about where we didn't pad it in. The other question that came up was a question about RUBS. So RUBS, I always forget what it stands for, but it's essentially the utility bill back.
Ratio utility billing system.
Thank you. Look at you.
Yeah.
So it's this utility bill back system. The question was how is it determined? So one way, as Ryan explained in the chat, is you can just take the total amount and divide it by the number of units. So you're paying $100 in water and there's 10 units, then each unit would pay $10 a month. Another way is you can do it by number of people in each unit, which is a little more complicated. But the way we like to do it is actually to sub-meter. So essentially with water, for example, you could still do the whole like just simple division, but we can actually install water meters at each line. And then the tenant themselves knows exactly what they're spending on water. So they have even more accountability. And it's actually proven to show even less or even more conservation when they can tell exactly how much they're using versus just the master meter division. So that's our plan. So going on to the budget. So these next two slides are the ones that I generally don't see people share. So it is a little bit more detailed, but again, we wanted to be transparent, just make sure we have everything, any questions we can answer here. So looking at the right first, our purchase price is 6.4. The total cost when we look at everything we're doing is about 7.6. So on the left now, and I'll just kind of bounce back and forth here a little bit, we're getting a loan for about 4.5, and then we're bringing in equity of 3.1. And 10% of that is coming from Dan, Ryan, and me. So we're investing in the deal ourselves. We've got skin in the game. As I mentioned before, another thing that I love about this is 2 of those 3 sellers are also investing and having a skin in the game. So from that 3.1, we've already raised over half of this, and we basically have enough to be able to close on the park. And the difference of what we still are raising from an investment standpoint is just enough to cover the capital budget. So looking at the right now, we have operating reserves of 100,000. Essentially, this covers anything that comes up that we didn't anticipate. So if there's some kind of gas leak that we need to fix, or some kind of major rehab that we weren't anticipating, that's just kind of a buffer, more or less, and it protects us in case there's something that goes wrong. The renovation budget, this is primarily going to Prairie Village. About at least half of that is going to Prairie Village. Between roads, as I said, other infrastructure and utility upgrades, tree trimming, and then we've got some tree trimming happening in Friendly Acres as well. But for the most part, the rest of the portfolio is good to go. For home purchasing, we have 300,000, and this is what I was referring to earlier, where we're bringing in enough capital to buy homes up front, and then we'll be able to recycle that capital as we sell them off. So we've been as lean as possible here, while still making sure we have enough to be able to be strategic in our sourcing of homes. Closing and financing costs, this is really what goes to the bank. So this number will likely come down. I kind of estimated it high just to be safe, to make sure we had enough. And so if it's less, then we'll just have more in reserves. And then that acquisition fee goes to covering our costs of all of our work to buy the park. So just to give you an idea, we first started looking at these parks in October, and have worked really hard till now to get here, trips, and we've put lots of money at risk to make sure this is happening. So I think we calculated out we're making about minimum wage with that based on what we've put in, but that's sort of a customary fee for just pulling together everything and making it happen. And then moving on to the pro forma. Again, this is another slide that I think most people don't show, but I wanted to be transparent. So please don't be intimidated by this. It's something that I can email out and explain, but there's a couple of things I did want to highlight. And if you'll bear with me, I'm actually going to go out of presenter mode so that I can zoom in a little bit and just kind of explain what you're seeing here, just because there's a couple of things that I think are really cool about this. So first of all, the pro forma is how much, what are we actually expecting for our returns? What are we expecting for the rent? All of that. So if you look at the top, T12 is actual. So this is what the park actually did last year. And then in the first year, we're predicting an increase in potential lot rent. This is coming from the new homes we're bringing in, the new rehabs, and the rent increase that already came in. As you can see in year 2, I'm putting in the RUB. So the utility bill back doesn't happen until year 2, but we're expecting it to happen in year 1. So that's going to help us out sooner than we think, but it's just not forecasted to be conservative. You see all of your expenses and then your net operating income. So I made sure that in year 1, our net operating income, again, this is to be conservative. I didn't want to have it jump $100,000 or so. So We made sure that the NOI stayed relatively consistent to be conservative. And then in year 2, because of all of the improvements and optimization we're doing, it does jump. Again, that's largely a factor of the new homes we're bringing in. But again, what I love about this, and there's a piece I want to reiterate. So this is year 1. We have 430,000 in our net operating income, and then debt service coverage ratio is a ratio that banks check to see how well is this cash flowing. So the bank cares, they want about a 1.2 debt service coverage ratio. This park is at 1.6, and that is only on lot rent, which is just phenomenal. So it's 1.6, and you get to add in all of this lease option income. So it's cash flowing like crazy is the short of this, which is just fantastic. So in year 1, we'll have about $250,000 we'll be able to cash flow out to investors, and then you can see forward the remaining that we were able to cash flow. So things look really good. You can see in year 5, this is our cash out refinance. We're expecting 4.7 net from the cash flow, and we're going to be distributing 3.7 of that out to investors. 1.1 million again will be held back for development. So hopefully you're hearing the excitement in my voice. I just think there's so many cool things that we're going to be able to do here. The final thing, this is just our final slide. Actually, it's not quite our final slide, sorry. Just quick things to reiterate. We've got skin in the game. We're investing in this with you. We wouldn't ask you to invest with us if we didn't believe enough in the project to put our own money at risk. Again, sellers are staying with it, which is pretty fantastic. Half the capital has already been raised, and we have an additional 20 acres of additional land that we can continue to develop on. This is just kind of a breakdown of the partnership. The couple of things I want to point out here is, again, our preferred member preferred return is 8%. And then we have, this is a 506C offering. That means that essentially anybody that invests needs to be what's referred to as an accredited investor. If you have questions about that, please reach out to me offline. I can explain to you, and we can talk through how that could work. And then, as I mentioned before, our first distributions will occur in November 2021, and they'll be monthly thereafter. Let's see if I wanted to explain anything else on here. I didn't explain before depreciation expense. Ryan kind of explained what this is, but really with the Jobs Act of 2017, you can actually take a ton of depreciation in year 1, and we'll be doing what's called a cost segregation study that lets us do that. So our estimation is if you invest $100,000, you'll be receiving about $60,000 year 1 in write-offs that you can take on this portfolio, which is pretty fantastic.
Brett, you got one question. I'm sorry.
Sure.
It'd probably be a good time to answer this one about the debt. Is the debt secured?
Yeah.
Already, and what are the terms that I think this has got several options there.
Yes, great question. So we have a lender that is moving forward. We're working on appraisals right now. Essentially the terms are we have 70% loan to value ratio, which is very strong. Obviously we'd hope for a little higher, but in an asset class like this, it's pretty common. It's 30-year amortization with 4.5% interest rate, which again, all of that is actually very competitive for this asset class. That being said, we do have a second bank that's looking to finance us, that all of those terms would be even better. And if that goes through, then the equity portion, this 3.1 would come down. We wouldn't need as much. And again, all of the returns get better. So really the returns that we showed above are the worst projected scenario. So they're really like lots of great things happening there. Okay, so someone's asking what is the asset management fee? So the asset management fee, so this is another fee that's common for partnerships like this, but generally I see it calculated on equity under management. So what that means is generally someone will say that their asset management fee is 2% of equity. So they would charge 2% of 3 million. And so that would be, what does that end up being? 60,000 a year? Am I doing that math correctly? And so what I don't like about that is that no matter how the asset's performing, the manager is receiving $60,000. Could be year 5, year 10, same thing, because you have the same equity under management. So we're big fans of aligning interests. So with the asset management calculation, we have 5%, and what that is, sorry, it's right here. So 5% of income. So if income goes down, we get paid less. If income goes up, we get paid more. And so that's a great alignment of interest. couple of caveats on that. This won't be paid until November either. So this is not paid out in any time before the preferred return. And if the preferred return isn't able to be paid, it's also not paid. The second thing is, if you look at the, sorry guys, I'm all over. Hopefully I'm not making people motion sick here. If you look at the year one pro forma, we've actually been able to cut several expenses from year one that were on the T12 or actuals because they're being paid by that asset management fee. So the asset management fee flows to an entity, our entity called HBR Properties, which does all the asset management. It covers accounting, it covers legal, it covers bookkeeping, it covers travel for us, and all types of expenses there. So it's not a fee that anybody's getting rich off of. It just kind of covers the operating, general operations for us. Were there other questions, Dan?
No, that
Nope,
was the last one for now. One thing I think Brett's alluded to it, but if you're risk adverse, Brett's underwriting is right up your alley. He's super conservative with his numbers. So like he said, we're anticipating higher returns than we're projecting here, but this is like super safe numbers for us to put our names to.
And then this is just the final or the next step. So we'll be sending out the subscription documents in the next couple of days. What that is it's essentially the legal documents that just kind of show it's like you're going to be joining a limited liability company with us, or an LLC. So you're joining that with those documents. And then we'll look for soft commitments next week, which essentially means is when you're pledging how much you'll be able to do. And then May 5th is our funding deadline. So if you're investing, we'll need your funds by May 5th, and then we close May 14th. Let's see, are there any other questions? I'm not seeing anything in the chat, but at this point, I will come off of sharing, and maybe we can, if anybody wants to come off mute, you're welcome to, and we can have a conversation, or just drop it in the chat.
So one question, Brett, equity multiple is 4x, but your projections show only 2x. Can you please explain?
Equity multiple is 4x. I'm sorry, I'm not understanding that.
Yeah,
4x.
But projections are showing 2x. I don't know where it was showing 2x exactly.
I'm not sure either. Sorry, could the person asking that question maybe clarify a little bit?
This is Silva. I asked the question. If you go to the yearly slides where you show if you invest 100K, this slide, you're showing 4.1x, right? Equity multiple. It means that if I invest 100K, you are telling me that I'll get 400K return, correct? That's what it is. But I'm seeing here only, I'm seeing only here like 2x. Like if I invest 100K, and then I get only 100K back, or 110K back, right?
Yeah, so you're actually gonna, so you would calculate it by adding up all of this cash flow you're getting, and then add in this 110 and this 185.
So it means 10 years then, not 5 years.
That's right, yes, it's a 10-year hold. Yep, we have a 10-year hold. Year 5 is when we refi and pay everybody back their capital, but you're staying in the deal and still getting some cash flow, even though you don't have any investment left. And then you still get the upside at the end.
Okay.
Does that help?
Thank
Sorry,
you.
I'm completely misunderstood, but hopefully that helps. Okay, and then we have a,
No, I'm good. Thank you.
Perfect. Okay, great. Okay, and then we have a question of 50 sponsor, 50-50 split over 8 preferred, operating cash for all income. Okay, great question. So, okay, so we have 8% preferred return, and as I explained before, this is paid before anything else. So it's the most important thing that gets paid out. Well, I should say after the debt service. So bank gets paid first, and then all of us investors, which by the way, will be considered investors as well, because we're also investing in the deal. We get paid second on whatever we've invested after the bank only. And then after that, we split the profit. So any cash flow that comes either from operating cash flow or capital appreciation will be split 50-50. So in multifamily space, I've done a lot of projects like this with like apartment complexes or industrial. And I know one of the questions is, sometimes you see more of like a 70-30 split. and this is a little bit more aggressive. And the reason for that is with the work involved and the effort involved, it's just a little bit more of an aggressive thing for sponsors, and we're bringing a lot more people on the management team than you normally would because there's so much work to do. So hopefully that explained that question for the 50-50. Just kind of skimming the questions, see if there's any others. So I want to be sensitive to time. I know that we're at the hour, a little over an hour here. So we will stick around in case anybody has questions, but feel free to drop off if you'd like. We are going to be sending out this recording, and we'll also send out the full deck as well. So you'll be able to download this deck. With that said, it looks like we've got another question. Year 10, 185 capital event in 100K scenario assumes sale at year 10. Yes. So this 185,000 we have here does assume a sale at year 10. So the reason I have a year 10, and I've run multiple scenarios, and the reality is we will rerun the scenarios every year based on market conditions. So based on what we know today, this is the best way to optimize our returns. So we get return of capital in year 5, and we get to benefit from a further appreciation into year 10. This assumes no development PS, so that should be better if we do any development. But there's scenarios where we could refi in year 4, sell at year 7, or just sell at year 5 and not even worry about a refi. And we will look at that every year and evaluate the best scenario. But based on what we know today, this is the scenario. Great question. Someone's asking if there's a soft commit link. The answer is yes. We will make sure that you are in our Syndication Pro platform. It's the platform we use to keep track of any soft commitments. It's also how you will help wire the transfer, and you can see your returns in there. And my favorite part, it actually does the returns or the distributions monthly automatically for us. So it makes it really easy. So we will make sure you're in there, and then that's where you'll make your soft commit. So you'll get a link and then can do that. And if you miss that, feel free to email me. And let me just show again my email address here. So those should go out by tomorrow at the very latest. And actually Ryan just sent a link in the chat as well. So this is a link you can go to and kind of see the highlights. And then you can see, I think that the link at the top says register now or invest now, and that's where you would just make the soft commitment. Good question. It's good to see you all again. It's like when you're sharing, I can't see any faces, so I'm just like talking to myself. Are there any other questions the group has? Okay, well, we'll go ahead and drop. Again, we'll share the link for the recording as well as the link to the deck, and please feel free to reach out. I'll just drop my email address in the chat as well, just as another option there, and then let us know. Okay, so there's my email address. With that, I hope you all have a great night. We're really looking forward to partnering with you on this and any other future options.
Great, thank you.